Hey everyone, welcome back to The Explainer. Look, today we are tackling what is, without a doubt, the single biggest, most paralyzing dilemma you're going to face when you first open up an options chain. You know the feeling, right? You're staring at this absolute sea of numbers, blinking lights, rapidly changing prices, and you have to make a choice. And honestly, it's a choice that can literally make or break your whole trading strategy. How do you know exactly what to buy? Well, today we're going to break down option trading mechanics, specifically focusing on how you actually pick that strike price. And maybe even more importantly, we're going to uncover the hidden mechanism that is constantly working against option buyers behind the scenes. So let's just dive right in.
So this brings us to the ultimate question, right? Which strike price should you actually buy? Are we talking ATM, ITM, or OTM? Now, if you spent, even 5 minutes looking at the share market, you've definitely seen these acronyms. But knowing what they stand for and knowing which one to actually put your hard-earned capital into, those are two entirely different things. Today, we're not just defining these terms, we're going to compare them head-to-head. And hey, quick teaser here, stick around, because as we map out these strike prices, we are also going to reveal a massive hidden danger known as premium decay. Trust me, it's a concept you absolutely have to master if you want to survive out there.
All right, Section 1, the nifty option chain.
Let's ground this in a practical, real-world scenario. Imagine the Nifty Index is currently trading right at the 25,000 mark, okay? That 25,000 level, that's our anchor. So right in the middle, we've got the ATM call. That stands for at the money. The ATM strike price is 25,000 CE, exactly matching where the market is right now. Then, just above that, we have our ITM, or in-the-money call, sitting at a lower strike of 24,900 CE. And finally, right below that, we have the OTM, or out-of-the-money call, which sits at a higher strike of 25,100 CE. This little setup is basically your fundamental roadmap. Whenever you're looking at a share market chart and an options chain, you're really just navigating these 3 specific zones relative to the current base price.
So where should you start? Well, the ATM. At-the-money strike price is generally considered the absolute sweet spot for beginners. Why is that? It's all about balance. First off, the premium isn't too expensive, so it's pretty accessible. Second, and this is absolutely crucial, it has a significantly lower risk of just suddenly dropping to zero compared to other options out there. And third, it accurately tracks the price movement of the underlying index. I mean, if you're looking at those green candlestick patterns and Nifty starts moving up, your ATM 25,000 CE is going to react smoothly and predictably. It's just the safest, most balanced choice for navigating the market as you build your confidence.
But what about the other two? Let's talk about ITM, in-the-money options first. Yes, they are slightly more expensive up front. You definitely have to pay a bit more. But in return for that extra cost, you are getting significantly lower risk, way higher stability, and, this is key, the absolute slowest premium decay among the 3. Now, let's flip it and look at the ultimate beginner trap, OTM, or out-of-the-money options. They look so incredibly cheap, right? It's highly tempting. But here is the massive catch. OTM premium depletes at a frighteningly fast pace. If we compare premium decay speeds across all 3, ITM decays the slowest, ATM has a moderate manageable decay, but OTM decays the fastest by far. It carries a ridiculously high risk of total loss.
Which brings us to Section 2, the silent killer, premium decay.
So what exactly is premium decay? Simply put, it's the inevitable decrease in an option's price as time passes, even if the market direction remains completely flat. Think of it like a melting ice cube. Even if you literally don't touch it, it's just sitting there shrinking by the second. And actually, retail traders lose millions of dollars collectively every single year just because they ignore this melting effect, which is known as theta. Normally, in the share market, you lose money when the price goes against your prediction, right? Makes sense? But in option buying, oh no. You can accurately predict that the market won't drop. The market can stay completely flat, just moving perfectly sideways, and you will still lose money. Time itself literally eats away at the value of the premium you bought. It's the hidden mechanism constantly working against you.
Let's visualize this terrifying reality with a really simple time-based example. Imagine you start by buying an OTM call, and you pay a premium of 100 rupees. Now imagine the Nifty Index doesn't crash, but it doesn't rally either. It just kind of sits there. It's a classic time pass scenario. Well, as time passes, your 100 rupee premium drops to 80 rupees. The market is still flat, but more time passes. Now your premium is down to 60 rupees. As you approach the expiry day, that decay speeds up aggressively, dropping your premium down to 30 rupees. And finally, when expiry hits, if the market still hasn't moved in your direction, that 100 rupee investment goes to absolute zero. It's just gravity. The relentless gravity of time in the options market pulls everything down.
All right, let's get into Section 3, Strategic Rules for Option Buyers.
This source material actually gives us some incredibly clear, actionable steps to defend against all this decay. Step 1 is a hard and fast rule. Avoid buying far OTM options, especially in weekly expiries. Why weeklies? Because in a weekly expiry, that timeline we just talked about is insanely compressed. The decay happens brutally fast. The cheapness of that OTM option, it's a total illusion. Then there's step 2. To create a safer risk profile, you need to deliberately choose ATM, at the money, or slightly ITM, in the money strike prices. Look, yes, they cost a little more upfront. We already established that. But they offer the stability you desperately need to survive the inevitable passage of time while you wait for those red and green candles to actually move in your favor.
Which brings us to the ultimate golden rule here. In option buying, just getting the direction right isn't enough. Time must also be on your side. That literally summarizes the whole shebang. You can be the absolute greatest chart reader in the world. You can spot the perfect candlestick pattern from a mile away, and you can correctly predict that Nifty is about to skyrocket. But if you buy the wrong strike price, like some far OTM option, and it takes just a little too long for the market to make its move, that premium decay will drain your account before you ever even see a profit. Time is a variable you just absolutely have to account for.
So, as we wrap up this explainer, I want to leave you with one final, kind of provocative thought to chew on before you execute your next move. Look at your own strategy. Look at the strike price you're considering right now and ask yourself honestly, is time on the side of your next trade? Because if you are just blindly buying cheap out-of-the-money options and, hoping for a miracle, the clock is ticking, and that premium decay has already started. Be smart, stick to at-the-money or in-the-money for stability, and respect the mechanics of the options chain. Thanks so much for joining me today, and keep learning.